That's the closing bell on Wall Street, and now it's market domination overtime. Let's see where the major averages did end up today. The Dow, it looks like we're going to finish up about 260 points. The S&P 500, your broad gauge, is going to be down about 0.1%. Tech-heavy Nasdaq is going to finish down about 0.33%. Russell 2000, meanwhile, your small caps, that finishes in the green, up about 0.5%. Turning now to data and markets editor Jared Blikre for more on the moves. Jared.
Well, thank you, Josh. Let's go through the major indices. We'll take through them. The Dow finishing the day up 260 points, or about 0.5%. If you look at the intraday price action, not much change from right before the Fed announcement was dropped at 2 p.m. We went up, we went down, and then just kind of settled back into that 0.5% range. So not a lot of movement in that index. Nasdaq Composite was red all day, and it ended the day down about 1/3%. S&P 500 down just a tiny bit, 0.1%. And then also looking at the small caps, very similar story, just barely ticking down into the red. And let's take a look at the sector action. We didn't have any record closing highs in the indices to note, but XLF, that's financial ones, this was its first record high in about 2 weeks, I believe. So count that for XLF. Also finishing in the green today, staples, communication services, utilities, energy, materials, and also healthcare. What didn't do so well? Industrials, tech, and consumer discretionary. And if we take a look at the Nasdaq 100, we see a split board here. Not a huge loss, but a little dark red there for Broadcom, down almost 4%. Nvidia also down 2.5%. Microsoft and Apple just barely positive. And I got to highlight China because China's been up all day, didn't really react to the Fed, but we're seeing some outsized performance. Take a look at Pinduoduo up about 4.5%, Baidu up 11%. And over the last few days, I've been tracking the action and the difference reaction that we've been seeing in bank stocks. Here, that's energy. Let me get the bank stocks. These are the big bank stocks. A lot of these in XLF today, so those did well, but also regional banks. Those are coming from behind over the last 2 days. A lot of red on that board, but not today. USB up 2.5%, PNC up 1.4%, and the list goes on. So I'll leave it here on our leaders board. KWEB, that's China, and then KRE, that's regional banks, number 1 and 2 spots, followed by IPOs and then solar. Then the basement here of the day, cannabis, looks like Korean stocks, and also IYT, that would be the transports. Josh, back to you.
Thank you, Jared. Investors now parsing the dot plot and Fed Chair Powell's tone for clues on the path forward for Fed policy. Joining me now is Eric Friedman, Chief Investment Officer at U.S. Bank Asset Management Group, brought to you by Capital Group. Eric, great to see you, especially on set. Let's start with the Fed. What did you make of what you saw and heard today, Eric? What were your big takeaways?
I think the biggest one, Josh, number one, is a big, let's call it underscoring of just how weak the labor market is in the eyes of Chair Powell. I'm not going to call it, a cataclysmically challenging, if you will, but still a supreme shift that we've seen over the past couple of months from Powell. Very focused on inflation. Now that is, I think, a paramount shift over to the weakness in the labor market. Second point, which I think is probably lost in the shuffle, is what happens to the longer-term dot plot, which, again, everyone's focused on the next couple of meetings. But really, for investors, one of the big factors is just where is that Fed neutral rate? Where do they see interest rates, at least in terms of their median, Fed funds target settling in? And that actually went up very marginally again, despite having Stephen Mirren and a couple others that have been pushing for rate cuts. The fact that you had that longer-term dot plot level increase yet again, we think is important. So it doesn't change our glass half full bullish perspective, but certainly interesting that Powell is again focused on labor market weakness, but then also this idea that still the ultimate level for Fed funds is probably higher, not lower.
You mentioned Dr. Stephen Mirren there. Now, he was the dissent, right? He wanted to see a jumbo-size cut. I did have some strategists, Eric, on the show this week, and we were talking about that. Some of them thought if you had done that, you might have really spooked the market. But what do you think?
I think there's probably some level of posturing in terms of just that idea of, will Dr. Mirren be on the short list for the ultimate Fed chair replacement? If you look at some of the prediction markets, you saw some gyrations between, both what happened with Mirren as well as what may happen with Kevin Warsh. So I think the roster is still building, if you will, in terms of that short list for the next chair of the Federal Reserve. So I think some of that was probably posturing, but we do think that, again, the bias probably from, again, most Fed constituents is that interest rates should head back towards that lower level, if you will, in terms of getting back towards long-term Fed funds target.
Let me ask you, bottom line, did you see or hear anything today, Eric, that caused you to say, listen, I got to rethink where I want to put money to work?
Nothing significant. I think that if anything, the about face that the Fed announced happened really more in Jackson Hole. That was both a reset on the Fed strategy as well as a reset on this notion of labor market being probably a bigger concern than inflation. So I think in general, you got probably a little bit of everything that you anticipated in terms of what came out of the Jackson Hole session. But I do think that, again, the room is probably changing a little bit in terms of the variables they're going to focus on. So again, when you have the labor market shift that we've seen over the past, let's call it 4 to 6 months, that does have the attention of the Fed. That probably gains a little more attention from individual constituents that maybe were a little more quiet about that factor a couple months before.
Some have argued the Fed is important to the stock market, for sure. You got to pay attention. AI is more important. You agree with that?
I do. I think that in the very near term, I think the Fed is. I think over time, AI will likely take a back seat. But in the very here and now, I do think some of the studies we've seen, again, that Stanford piece that came out about challenges, especially to newer entrants to the labor market, that's really being driven by AI. So if you look at the the sort of confluence of factors right now, you've got a weakening labor market, but you also have this AI push, which is really impacting entry-level positions, especially entry-level positions that used to lead towards more white-collar type of jobs. So near term, I do think AI is of utmost importance, but again, over time, the Fed is always has a very important hand.
Let me ask you, so your clients come to you, they say, listen, where should I be overweight in the U.S. stock market? What are you telling them?
Yeah, we still think that technology would be the most natural answer. I think that the CapEx cycle continues. Again, not just, this isn't like a rerun of the 2000 playbook of overinvestment in technology. These are free cash flow generating companies that are spitting off a lot of opportunities for, again, re-entry into their CapEx budgets for tech spend. So I think that's still a place where we want to be. An area, Josh, that we think it's less attention that we find very interesting is global infrastructure. This has a combination of both inflation protection. It has some yield attached to it as well. You've got some, transportation of goods and energy, but it also is a very underloved, underappreciated sector. We also think, again, in picking up some utility exposure there, which is not a bad place to be. So global infrastructure, generally off people's radar screens, we think should be on people's radar screens.
What's your guidance for fixed income investors?
Yeah, we still think that municipal bonds is the underloved asset class, if you will. I think if you look at taxable equivalent yields, especially for our wealthier clients, you're talking about 7, 8, 9% taxable equivalents, especially if you look at municipal high yield. That's a spot that we really like. We also think that reinsurance also tends to be off people's radar screens. That's something that we think is very differentiated. Last thing would be structured credit. We still think that things like non-agency mortgage debt do offer some interesting yields. So we'd be a little less interested on government debt. We think that owning some yield that is, again, not just tied to the business cycle, those are things that we like in this environment.
Eric, always good to see a fellow Colgate alum in person.
Go Raiders.
Thank you, sir. Coming up, Lyft stock is getting an acceleration after an important announcement. We are speaking with the company's CEO. It's a conversation you don't want to miss. Stick with us. The Fed cutting interest rates on Wednesday by 25 basis points. We also got a new summary of economic projections along with the decision. And Yahoo Finance senior reporter Allie Canal joins us now to break down the details. Allie.
Yeah, Josh, that's right. In addition to the Fed's first rate cut of the year, the central bank is now signaling 2 more in 2025. That would take the benchmark rate down to a range of 3.5 to 3.75% by year end. This comes from the Fed's so-called dot plot, which charts policymakers' projections. Now, the latest read was a bit more dovish than June. Nearly every official expects some sort of easing this year, with more penciling in 3 cuts. Some have 2, and one calling for as many as 6. At the same time, the Fed upgraded its growth outlook but flagged a weakening labor market, suggesting policymakers are prioritizing jobs even as inflation remains sticky. So let's break down a bit more. You're seeing on your screen there some of the longer term projections, and there was a lot of dispersion in this September dot plot. Like I mentioned, one policymaker anticipating 6 rate cuts by the end of this year. Just one thinks we will hold steady at where rates currently were. This is a change from what we saw in June. So a more dovish Fed this time around. And a lot of this has to do with the fact that we have inflation remaining sticky. We have weakening labor market dynamics. And there was a lot of differing opinions here from FOMC officials. Now, this is something that Jerome Powell was specifically asked about during that post-decision press conference. He said it's natural to see some dispersion, especially as we're operating in an unusual economic environment. So let's talk about some of the other projections here. GDP, that was revised up from what we saw in June to 1.6%. By 2026, we are expected to reach 1.8% and then near closer to 2% in 2027. And then over the longer run, FOMC officials anticipate 1.8% for growth. So the economy is still growing, and that's at least the expectation. And then if we take a look at the unemployment rate, same with June, 4.5%. We're currently at 4.3%, so a slight uptick there. We are expected to hit 4.2% by 2028 and remain at that level over the long term. But inflation, that is expected to be a little bit more sticky in 2026 compared to those June projections. So 3.1% expected this year, 2.6% in 2026, and then we will finally reach the Fed's 2% target all the way in 2028. So something to continue to watch, especially as tariffs continue to work their way through the system. But all things considered, it was a very interesting post-decision press conference. Many economists who we've been speaking with on the program today said that the conference was actually a little bit more hawkish than maybe the cut suggested. So all things to look out for here, Josh, as we continue to parse through a lot of this commentary and really analyze what the Fed ultimately decides to do through the rest of the year.
All right, thank you, Allie. We'll turn now to Cracker Barrel, company reporting its fourth quarter results, and Yahoo Finance's Brooke DePalma joins me here to break it all down. Investors don't look so happy with this one, Brooke.
Investors not too pleased, and that's largely because of the outlook that the company provided. The company did say that they now expect total revenue for the fiscal year between $3.35 billion to $3.45 billion. That, they said, assumes a comparable sales, or rather a comparable store traffic decline of between 4 to 7%. Now, this stock is something that has gotten so much attention in the last month alone. Shares are down about 20%, and that's largely because of the backlash that the company has gotten based upon their rebrand of the logo. They have since now returned, or rather returned to what was their prior logo, and also the pause on redesigns that the company has been undergoing. But keep in mind, earlier this year, the company was posting major renovation plans, major, new redesign plans, and really making a $700 million investment. And we did see just a bit of that, play off a bit. They did beat on their top line, coming in at $868 million, but they did miss on earnings. That came in around 74 cents, 2 cents lower than what the street projected. If you also take a look at same-store sales growth during the quarter, they did have restaurant comp sales increase by 5.4%. That was more than the 3.43% the street had projected, but their retail same-store sales did decline just ever so slightly. But really back to this outlook, after that backlash had happened, we heard from so many on the street that this could cause some hubbub, cause some, excitement for consumers to return. And now, based upon this outlook, they're saying that they expect a store traffic decline of 4 to 7%. It's certainly not what investors want to hear, especially after all the attention that it got. They thought that maybe it would stir up some commotion and excitement to return.
All right, we're down about almost 8% here. What are you listening for on the call?
Well, we're really listening to how exactly the future of that $700 million redesign and next generation of Cracker Barrel will actually turn out to be, especially because now, one of those ways in which they were using that investment was towards the redesign of the restaurants and of the logo with the major marketing campaigns. And so I really think that investors right now are looking for some clear direction on how exactly this future design of Cracker Barrel will be. We know they put a pause on redesigns. We know they reverted to their old logo. So where exactly is that $700 million investment going? What does it look like? And what's the future growth plan here for Cracker Barrel? And how will it get underway after this major backlash that we've seen?
All right, we'll see. Thank you, Brooke. Appreciate it. Lyft shares are soaring in today's trade, rising 13% on the day. The company announcing a partnership with Waymo, launching a robo-taxi service in Nashville starting next year. Joining me now, we got David Risher, Lyft CEO. David, it is always great to see you on this show. So you announced this partnership, David, with Waymo, autonomous rides in Nashville. Great town, David, one of my favorites. But why Nashville? And is that just the beginning, David?
It is a great town. Hey, Josh, super fun. If you go to Nashville, you got to go to the Opry, as well as to sort of live the whole, bridal party life. But anyway, so no, look, super fun city, but also a tech-forward city, in a city that we've had a presence in for a long time. This deal does two things for our partnership with Waymo. First, it provides demand, right? We got millions of people every day who open up the Lyft app, and increasingly they're looking for an autonomous solution, which is great. And then second, it provides something called fleet management, which is what keeps the cars charged and ready to go. And this is something we've been doing for a decade, including in Nashville. So a lot of good reasons for it. It's also just, as you say, great city.
And let me ask you, David, what is going to sort of differentiate? What makes your partnership different than what Waymo has with your rival Uber?
Yeah, so I think it's two things. And again, I'll go to the same framework. On the demand side, we have something called integrated marketplace. It's kind of an integrated marketplace demand function, which sounds technical, but here's what it means. It means that we're taking these two fleets, all of Lyft's human-driven fleet and all of Waymo's, robot-driven fleet, and sort of putting them together in a very dynamic way. And without wanting to get too kind of technical on it, it means that rather than sort of thinking of these as two completely segregated things, where if you're on one app, you can only get to one. If you're on the other app, you can only get to the other. They're sort of dynamically integrated, 24/7. So it should mean, super fast pickup times for riders as well as high utilization, which gets to the second point, fleet management. Fleet management sounds technical. Think of like what happens when you take an airplane. Okay, you get on the airplane, it's got to be ready to fly. It's got to be cleaned, it's got to be serviced, it's got to be fueled. Same with cars, right? They got to be ready to go. And we've had this fleet management subdivision for years now called FlexDrive. And that's what they do. No other rideshare service has it. Ours is integrated deeply into Lyft. We already have about 15,000 cars on the FlexDrive program. A guy named John Parks runs it, by the way. He's a Green Beret. He's freaking amazing at what he does. And what the goal is to keep the cars always, always, always ready to drive. And we think we'll be able to do that better than anybody else.
Now, you, David, you have other AV partnerships too, right? You got another one with May Mobility in Atlanta. Right. I know that's early days. Any line of sight you can offer there, David, about how that partnership is trending?
I mean, it's super early, as you said. We're just sort of an early pilot there right down in Atlanta. But great so far, absolutely great so far. People really like AVs. And this is not at all to say that drivers won't have a huge, huge future in front of them as well. But it's great to have a new product that people find safe, find reliable. It knows the traffic laws, it follows the laws. Of course, it's quiet and kind of private in the car. So these things are things that people, I think, are going to like for a long time. And it's why we think that AVs are going to expand the market, wherever we go. We're actually seeing that in all the markets where we operate and AVs operate. Is our markets are actually growing faster than they are elsewhere.
And so with those AV partnerships, David, how are you defining success? Walk me through, what are the criteria? What are the metrics you'd be watching?
Yeah. So the first thing, frankly, I'm going to be looking for over the long term is growth, right? We want this to be a new product that we can offer to as many riders as we possibly can. When you sort of click, one down, we're trying to create something that hasn't been created yet, and it's called a hybrid marketplace, right? There are going to be human drivers and there are going to be robot drivers. And I want you as a rider to feel like I've got all the choice I want, and that no matter how I, get a ride, the service level is always going to be super, super, super high. That's what we always aim for at Lyft. And then from sort of a financial side, of course, it has to work economically, not just for us, but for our partners, for the Waymos of the world. They've got to feel like it's a success for them. And again, a lot of that is going to come down to, are the cars ready to drive? And then is the utilization high? In other words, are people paying, and are the cars moving around with paying riders in it? So a combination of great business metrics, but also great customer experience, I think is going to grow the market hugely.
Finally, Dave, we're always looking for line of sight into the consumer. You have that. I'm just curious, the consumer, how healthy, how resilient does the consumer look, David, based on your business?
Yeah, we see strength. We see strength. And, I know I read the same headlines we all do, and everyone's looking for maybe areas of weakness. But if I look across, I look at commute, it still is incredibly strong. In fact, it continues to grow. I think return to office, frankly, continues to be a bit of a tailwind for us in a lot of parts of the country. But even leisure travel, people going out for drinks or people taking, airline trips, whether that's for business or for pleasure. Honestly, we see strength across the board. Doesn't mean things can't change, but at least from what we can tell, consumers pretty happy.
David, I'll squeeze one in here. We did hear from the Fed today. There is some concern about a cooling labor market. When that happens, David, does that impact supply of Lyft drivers? Do you see more folks looking to come to you, looking to earn extra income?
It's a great question. And the answer is historically we have. Yeah, a driver supply now is as high as it's ever been. And if I can brag for just a second, we have a 29-point advantage in driver preference over driving for the other guys. In other words, people who drive on both, when they talk to us, they say, we like you 29 points better than the other guy. So, anyone looking for, a good way to bridge a gap or to come in and make extra money, I highly recommend driving on the Lyft platform. As you know, I do it too. But yeah, over time, what tends to happen is when the market maybe gets a little softer, it's a really easy way, 24 hours from now, if you've got a car and a good driving record or a safe driver and so forth, you can be driving on the platform. And it's a really important bridge for a lot of people, as well as a supplement if things get tough.
David, always great to see you. Thank you, sir.
Thank you, Josh. Been a pleasure.
Time now for what to watch Thursday, September 18th. We're going to start off on the earnings front. We're going to be getting a new batch of reports on Thursday from Darden Restaurants, FedEx, and Lennar. FedEx announced results for the first quarter after the markets close. Analysts expecting FedEx to face pressure from new tariffs and the end of duty-free small packages known as the de minimis exemption. China making up about 60% of the 1.36 billion de minimis packages FedEx shipped into the U.S. last year. And taking a look at the labor market, we're going to be getting another key piece of jobs data on Thursday with initial jobless claims. Economists forecast that number to fall compared to the week prior to 240,000, signaling that layoffs slowed and fewer people filed for unemployment benefits. And moving over to housing, weekly mortgage rate data from Freddie Mac coming out on Thursday. 30-year fixed mortgage rate falling to 6.35% in the last reading, the lowest rate since October 2024. Another drop on Thursday would make it 5 straight weeks of declines. That's going to do it for today's Market Domination Overtime. Thanks so much to Jared Blikre for helping us out with earnings today. On the other side of the break, it's asking for a trend. I've got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned.